Dear investors, welcome to the May 2025 monthly roundup video. The recent rate cut of 50 basis points, that is 0.5% by RBI, would reduce loan burden for existing borrowers, and more importantly, the CRR cut of 100 basis points is going to improve business as banks would be able to give more loans. As we maintain minimum balance in our bank account, similarly, banks have to maintain a minimum balance with RBI for operational emergencies. That is called CRR, cash reserve ratio. So CRR cut will give more funds to banks to the tune of 2.5 lakh crore by November 2025. RBI has definitely done its bit to improve the Indian economy. There is not much room left for the RBI to cut interest rates. The ball is with the government now as to how they are going to improve jobs and earnings at grassroots level and sentiment of businesses. Banks are always notorious in delaying to pass these rate cuts to borrowers, but are very swift in reducing fixed deposit interest rates. As you can see, FD rates on 1 to 2 years term has reduced to 6.5% and 7% for senior citizens. Savings account interest rate has also reduced to 2.5 to 2.75%. Please don't go to small finance banks or cooperative banks to get higher FD rates, as these banks may not be stable and you may lose your savings. The main indices are still down 6 to 10% from their all time high, and our portfolios are almost 4% in the positive. So, when markets recover completely, we could see a 10 to 15% absolute return in our portfolio. Please stay invested and keep investing in lump sum or SIP format, whichever way you are comfortable. And 3 to 5 years down the line, you thank me and yourself for staying disciplined in such a difficult scenario. While interacting with some investors during this market downturn, more often I got questions like, should we invest in PPF or fixed deposits to protect our savings? The vis-a-vis return of equity mutual funds with PPF is right here on your screen. So this whole idea of investing in PPF or fixed deposit, it's like you are traveling in a train and at a junction, the train halted for longer than usual. So you got down from the train and took an auto rickshaw because that was moving, although your destination was a few hundred kilometers away. That's stupid, right? The only concern we should have as long term investors is how should we invest our savings safely and get maximum return, not invest our savings safely and get bare minimum return, because inflation is always there to eat into your earnings, and well, your financial goals, they won't be fulfilled by the returns from fixed deposits. On the topic of inflation, May retail inflation came in at 2.82%, lowest in 6 years. So FD interest rates are going to be down for a while now. On the other hand, GDP growth is projected at 6 to 6.5% for this financial year, which is not the best, but it is still the fastest in the world. As Mark Twain said, history doesn't repeat itself but often rhymes. This saying can very well be used in the context of share market. Currently, based on GDP, inflation and valuation data, the market appears more like a mid 2018 kind of market where, despite of COVID-19, the market went up 70% in the next 5 years, which is a 12% compounded return. That is the kind of growth you could most probably see in your portfolio in the next 5 years. At this juncture, if we get stuck in low return products like gold, fixed deposit, and PPF, etc., in the name of safety, then in my humble opinion, it would be ignorant. Some of you may still say, look at the war raging in Iran and Israel. Well, the choice is yours. I can guide you and handhold you if you let me. There was the Russia Ukraine war, then Israel Hamas. A few days back, India Pakistan were on the brink of war. Now it's Israel Iran tensions that have flared up. Trump is in a dream world of his own, doing military parades, writing open threads on his X account, going to and fro in tariffs, immigration issues, and so on. Something or the other is always going to happen when you are a long term investor that would appear catastrophic in the near term. The incidents are real, but their interpretations are blown out of proportion by media and uninvested third party analysts. There is no point fussing over such news. I would like to reiterate that our strategy is designed to handle all these complexities as it is based on real data and not vague assumptions. Also, the strategy adapts itself swiftly to changes in economic and market conditions. So, stay invested for the long term. Increase your SIPs annually. Invest through lump sums and enjoy this journey of a lifetime in Indian equities because we are a generation where the US was after World War II. Short term is anybody's guess, but in long term, sky is the limit for India. Hope this video has been useful. Thank you. Happy investing.